Note though, at the same time, while Sydney was very strong, our Aussie share market has been extremely volatile of late. Most people know this obviously, but was actually off 7% over the same time period that house prices rose at that historic rate. Is there a link between the two markets? Can we draw any conclusions, if any? Now, David, I want to get you in on this. How frequently, in your experience, I know property is not your thing predominantly, but how frequently do you see a market, any market anywhere, go up nearly 10% in a 3-month period? Is it a common thing?
It's very uncommon. So there's a lot of statistics from academics, and one group of academics is Dimson, Marsh and Staunton from the London Business School of Economics. And what they've done is they've looked at asset classes in the Western world over a long period of time. I'm talking 115 years. And what they would argue is that share markets over 115 years go up at around about 10 to 11% a year, or a real 6.5% a year after inflation.
Yep.
And property tends to go up about 3% less than that.
Yep.
Property obviously has lower volatility,
yep,
but it also has a lower return on average. So when you get 10s or 11s in shares, or 6s or 7s in property, relative to inflation of 2s or 3s or 4s,
yep,
and you're actually getting that in a matter of weeks or months, consistently,
yep,
I think it's time to sort of be a little scared.
Yeah.
I think also, if we just carry on the argument a little further, in Australia we have a highly unusual situation. So, for example, the value of the housing stock,
yep,
relative to disposable income has more or less doubled in the last few decades.
Right.
The value of housing stock relative to GDP,
yep,
has more or less doubled in the last few decades. It's at record highs. But in conjunction with that, the indebtedness to disposable income and the indebtedness relative to GDP, again, is at record highs. So I see it as being, quite vulnerable, to be honest with you.
Yeah. So it's cheap money. Is that really what's underlying it?
It's cheap money. And looking at the banking sector, 25 years ago, about 2/3 of their balance sheet was lent to business,
yeah,
and about 1/3 was lent to households.
Yep.
And that has completely reversed because of the rules. Now, the rules are starting to shift away slightly to force the banks to have more capital,
yep,
on those housing loans, and particularly the investment housing loans.
Yep.
So I think what's going to happen is that, on a relative basis, capital is going to get a little tighter,
yep,
at the margin, but in conjunction with that, very, very high indebtedness, very, very high prices relative to our normal sort of disposable income and GDP ratios. And so I just see a scenario where property is going to have trouble performing.
Interesting. That's having you here again. Property is not your predominant focus, but is there any potential link between the stock market, its performance, and what happens in property markets, do you think?
Yes, there is, and I think it's very important for our viewers to understand that the resource sector, for example, accounts for approximately 15% of the total market, and the resource sector's in deep trouble on a global basis. So there are some, very, very solid businesses like Teck Resources, which is the largest diversified miner in Canada, Vale in Brazil, Glencore in Western Europe, and the like, and they have all come back typically by 60, 70, 80, in some cases 90% in share price terms. Now, it would be interesting for the viewers to understand that BHP and Rio have both come back approximately 50 percentage points from their highs of 3 or 4 years ago. Santos down 70%, Origin Energy down 60%. So these are stocks that not only a lot of people own, but a lot of people are employed by them.
Yep.
And interestingly enough, we're just looking, and I think you put it up on your chart earlier, Tony, that Darwin and Perth are both now declining in housing prices. And I think they're declining simply because, firstly, unemployment's going up. Secondly, there's a fear that people will lose their jobs, or there's a multiplier effect from the major mining houses hibernating and battening down the hatches. And thirdly, vacancy rates are starting to go up quite a lot. So I think the question now for our viewers is, will what we're seeing in the place places like Darwin and northeast Queensland and Perth, will that infiltrate itself to the east coast of Australia? And the fears that I have are that we've going to lose our car industry over the next 24 months, and that'll be many tens of thousands of jobs. And importantly, we know that China is dumping well over 120 million tonnes of steel all over the world. Now, China produces more steel than the rest of the world put together. Yep. They consume about 100 to 110 million tonnes less than what they produce. So that's going to be dumped on the world market every year for the foreseeable future, the next 2, 3, 4 years. So I think a lot of these commodities are going to stay relatively weak. A lot of these companies are going to batten down the hatches. I think capital expenditure will come off. And I think, there is a bit of a fear that what does the rest of the economy do about this? We've got to get our entrepreneurs out there, we've got our small businesses out there, we've got to get our education companies out there, we've got to get our internal tourism companies out there, but I just think it could be a little scary.
So does the investor out there at the moment, the people watching, do they get invested in commodities, or do they just sell the commodities companies that they have at the moment? I mean, would you continue to hold BHP given that prognosis, or is that a stock, at the moment, theoretically, before they said this week they're potentially going to dump the franking credits on their Australian dividends, they were yielding grossed up 10.5%, okay? That's pretty compelling for an income investor because it's not a company that's likely to go out of business in anyone's lifetime, right? But you're sort of saying that this is potentially a time to just walk away from those investments?
I think it could be a very, very tough period of time for these companies. I think there's a fairly good probability that their earnings are not going to go north in a hurry. And I think at Montgomery Investment Management, we're focused really on three things. And all three need to stack up. We need to be high-quality businesses. Yep. They need to have good prospects. And good prospects simply means the earnings are generally travelling from bottom left to top right.
Yep.
So a lot of these mining and resource companies are absolute antithesis of what we like.
Yep.
And thirdly, you need to buy them at the right price.
Yeah, definitely.
And if you can't buy them at the right price, have cash in the bank for a rainy day. So we've been quite cautious about the Aussie market for probably 9 months.
Yep.
And our funds have been typically 25% in cash.
Yep.
And interestingly enough, you said that the market, I think, financial year to date, so since July the 1st, is down 6 or 7%. And I think our products are probably about break even domestically. So that's why you're breaking even when the market's down 6 or 7%. Not because you're a great stock picker, you're just missing a lot of the bombs.
That's exactly, and that's an important thing in a portfolio, isn't it? It's the disasters that you miss quite often that dictate relatively good performance, isn't it? If you can avoid the potholes in the road in terms of investments, you tend to do generally a little bit better than the index in the long run, don't you?
Well, as a generalisation, when the stocks decline, they decline much more quickly when the stocks go up.
That's right.
So if you can avoid those declines, and no one can do that exclusively, but if you generally can avoid those declines, you tend to do much better than the averages.
Definitely. Now, we do have a caller on the line at the moment. Barry has a call, I believe, in respect of BHP and South 32. Barry, go ahead. What's your question for the panel this evening?
Good evening, gentlemen. Look, I'm interested, what I'm trying to do with my super fund, I know BHP and South 22 are probably at their lowest, and what I'm trying to do is reinvest dividends from other stocks, including Telstra and ANZ Bank, into those companies. They're a cheap price. How do you see the future for those?
All right, that's a good question. So what's the outlook, David, do you think, for those companies and I suppose for yield stocks generally?
Well, Barry, I think what makes something cheap is the share price versus the valuation of the company. And a lot that goes into the valuation of the company is the prospects for that company over the next 2, 3, 4, 5 years. And unless you're a major bull on China and a major bull on iron ore and a major bull on coal and a major bull on copper, I don't know how you can or a massive bear on the Australian dollar or a combination of those, I don't know how you can stand there and say the prospects are exceptional and hence it's cheap. I'd rather try to get you to think in the following way. Here's a business, it doesn't really matter what it is, and over the next 5 or 6 years, I have a high degree of confidence that its earnings are going from the bottom left to the top right. And I don't think it's priced that way. And we've seen in the last 12 or 15 months examples of 4 or 5 businesses like that. So Icentia floated last June for $2. It's now approaching $4. ISD is its code. International Patent Holdings floated last November at $2.10. It's now $7. We've seen what Bellamy's have done, $1 to $7. We've seen what Blackmore's have done, $30 to $130. So they're out there. I'm not saying Montgomery has them all by any means, but they're out there. And in each case, I think what we can say with confidence is that the earnings are going to grow very, very solidly over a period of time, and hence, relative to a year ago, they were cheap. And so if you can buy high-quality businesses with good prospects, they tend to look after themselves. And I'm just not sure if you can say that, unless you're a massive bull on China and hence the underlying commodities. I'm just not sure if you can necessarily say that about the leading mining companies around the world, even though many of them are off 50, 60 or 70%.
I'll hear from Brian, who asked us a good question related to this. I am looking at asset classes to invest in that are not correlated to the stock market, as I have a large exposure there. Can you advise whether REITs have a good history of non-correlation, whether certain funds are better than others? This is a really good one, David, just in the context of the things you were talking about. So as you mentioned before, your fund is somewhere around about, just call it flat in terms of performance in the current financial year, yet the market itself, the ASX 200, is off 7%. So clearly you're doing something right, but it also goes to the point you were making before. You're in the businesses or you're in things that are clear growth prospects, but what about diversification, as Brian's asking about here? How do you get diversification in your portfolio, considering, again, you're sort of wedded to the Australian market in a way?
Yeah, well, as I said earlier, Tony, you know, high-quality businesses, good prospects, right price. If you can't find them, don't be scared to let the cash build up. So our portfolios have a little north of 20 percentage points in cash at present. So that's a natural diversifier. I know a lot of people look at it and go, I'm only earning 2.5% on it or 2.75% on it, but at least you're not going backwards. And we've seen in the last 6 months that, you know, the markets have gone back by 10, 12, 13%, and many stocks have gone back by 30%.
Yeah.
You know, even the banks that were such reliable yield plays have all, on average, declined by 25% since April. So sometimes it's better to have money in the bank for a rainy day, for when things are really cheap. And then you can go out and buy them. I know it's a good time to buy because you'll be petrified to do it. But that's crucial. REITs are an interesting one because they're really quite a big play on two things: property and interest rates. And I have a view that you should never really pay more than what we call the net tangible asset backing of these businesses. So if the net tangible asset backing, which is the backing of the company less the debt divided by the shares on issue, happens to be $1, I don't understand why people would pay $1.20 or $1.30 for that dollar worth of value in property. I would prefer to buy it at 70 or 80 or 90 cents in the dollar. But it's definitely a diversifier, but obviously you know, it's vulnerable to either rising interest rates, and we've had a massive bull on interest rates over the last 3 decades, or fall in property. Now, within REITs, there are different properties. There's obviously shopping centre properties, there's commercial properties, there's industrial properties and
developers, the whole box and dice,
Correct.
isn't there?
Correct.
Yeah. Do you see, are any of them attractive to you from an investment management standpoint?
Look, it's just not a space we play in. Yeah, what we're trying to do is, again, we're just trying to find high-quality businesses, you know, who've got very solid growth prospects. And we see the REITs as being much more of a sort of property stroke interest rate hybrid, I think.
Definitely. So just a couple more questions while we still have you here, David, and things I'm sure most people want to know out there. From your standpoint, the market over the next 6 months, up or down or more volatility? What do you see?
Well, I think more volatility, but I think there's a high probability now that interest rates will actually even come down a little further.
Right.
I noticed ANZ today was saying possibly the cash rate, which is already at a record low, I think pretty much a post-war low of 2%, might actually come down to 1.5%. And I suspect if that's the case, that will be quite supportive for the market. I think the other point to make is that the Australian dollar now, it's fallen from 110 cents to the US dollar to 70 cents to the US dollar. I think it's got further to go, particularly if we do cut rates. It may fall as low as 60 cents in the US dollar in the foreseeable future.
Right.
And I actually think that'll be quite supportive for some sectors. So anything to do with agriculture, I think, will enjoy that immensely. Anything to do with, I'll call it domestic tourism, education, I think, because people will still look at the low Australian dollar on a relative basis, and the numbers will increase. So there'll be pockets. The other thing is that we have some really great industrial companies that have a lot of revenue from Western Europe or North America, and they'll obviously are and will continue to enjoy this decline in the Australian dollar. So there's lots of pockets that I think will do quite well.
Definitely. Last thing then, international equities. Is that a good thing for a retiree's portfolio given the direction for the Aussie dollar? Is that not favourable for that sort of an asset?
Yes, and I think, you know, even a move from 110 cents to 70 cents, you know, you've made 40% or 30% just on the decline of the Australian dollar,
trade.
as long as you've been in an unhedged fund. But interestingly enough, many of these global markets over the last 2 or 3 years have performed significantly better than the domestic markets. So you've typically made 30 or 40% on the currency and then another 30 or 40% or 50 or 60% on the stocks. So a lot of people over a 3-year view have actually more or less, say over the last 3 years, have more or less doubled their money. Now, the easy fruit's definitely been picked. There's no question about that, but I think Australians generally are chronically underinvested internationally.
Yeah, interesting area to be in, isn't it?
We just don't have the great technology or health care stocks that a lot of these that are offered in North America and Western Europe.
Definitely. David, thank you so much for joining us this
Pleasure,
evening.
Tony.
Everyone, a big thank you to David Buckland, who's the CEO of Montgomery Investment Management, for joining us this evening.